How's it going, everyone? Welcome to the sweep. We're going to get started here in just a minute. As you guys get logged in, feel free to chat in, say hello. Whatever questions you might have, feel free to ask. And at some point during the session, we'll go ahead and get to those questions. All right, let's go ahead and get started. As always, like, share, and follow on social media. There are the links. Feel free to pause or rewind as necessary, but we're going to go ahead and kick forward. So let's start with news like we usually do. So another good week. Some cool stuff happened this week. We had some, and we talked about this last week, where we had some FOMC announcements, and this was on Wednesday. So we're not going to talk about that today, but I did want to point that out, and I'll kind of show you guys here in a moment what happened as a result of those. So tomorrow we've got FOMC member Williams speaking, and this is on Saturday, right? And due to speak about international coordination of monetary policy strategies at a virtual conference hosted by the Swiss National Bank. Audience questions are expected. So a lot of times when there's audience questions expected, that means that there could be some unforeseen things that the member can speak about that could very well cause for the market to react. Now, obviously, retail traders like us are not able to trade on weekends, but there is still trading happening. So, the market could open up on Sunday, and there could be significant movement that had occurred as a result of what happened over the weekend. So just something to keep in mind. So hopefully you guys are out of all your trades. You don't have any active or open trades. Otherwise, sometimes, you can suffer some slippage, and, the market can gap beyond your stop loss and take you up for more of a loss than you had anticipated. So just some heads up. Okay, so that brings us to Sunday. We've got German federal elections. So that's all day on Sunday, September 26th, which that's going to be their Monday, but this is Sunday for us. And daylight savings time shift for the NZD, so New Zealand, and then SPPI for Japanese yen. That's a low impact. So really it's just the euro and their German federal elections. Monday, pretty soft. BOE, Governor Bailey speaks. This is Bank of England for the Great Britain pound. This is 12 p.m., so 2 p.m. Eastern. And that's pretty much it. Everything else are kind of soft, right? Some medium impact announcements for the euro and USD, like FOMC members speaking, core durable and durable goods. And then FOMC member Williams speaks twice. You can see that. And then Brainerd speaks. So a lot of FOMC action there, but they're all medium impact. But just be careful, because those can sometimes cause, unforeseen volatility in the market. Brings us to Tuesday, a really light Tuesday again. CB consumer confidence is medium impact for the U.S., and FOMC member Bostic speaks, and that's at 1 p.m. Mountain, 3 p.m. Eastern. Wednesday, we've got a lot on the calendar for Wednesday. Bank of England Governor Bailey speaks for the GBP at 9:45 a.m., and that's 11:45 a.m. Eastern. And then Powell speaks. This is the Fed chair. Powell will be speaking at 9:45 as well. And then Lagarde also speaks at that same time, I think. Oh, and then right here, this is Bank of Japan. Kuroda speaks. So there's a lot of speeches going on for the various banks. Keep an eye out for those. That could get dicey, guys, so watch out for that. 9:45 a.m. Mountain, 11:45 a.m. time on Wednesday. Okay, let's go to Thursday. Thursday, another, looks like a really light week thus far, right? A lot of medium and low impact announcements. So not much kicking up as far as we can tell. Obviously, these are things you want to check on a daily basis because they do get updated. Like we're looking, at this point almost a week in advance, and things can be added to these, or dates or times shifted. So make sure that you're always checking announcements. Not because you want to trade, not because you want to trade during these times, but rather because you want to avoid some of these times so that you don't get caught in unnecessary volatility. That brings us to Friday. And Friday, we've got the CAD GDP, and USD Core PCE Price Index, and then ISM Manufacturing PMI for the US dollar later on as well. So keep an eye out for those. And then that brings us to Saturday, and there's just the Aussie Daylight Savings Time shift. So, not much. It looks like a pretty smooth sailing for the week. So if we go back to, just for a moment, Wednesday, we had the federal fund rate, right? And the expectation was that it was not going to be raised, right? There was no expectation that the federal fund rate was going to be raised from less than 0.25% to anything beyond that. And the last few have been the same as well, right? Less than 0.25%. Matter of fact, if we go further, we can see ever since 2020, January 29, 2020, when we were at about 1.75, and then we dropped March 3rd, right, as a result of the pandemic to 1.25, and then March 15th all the way down to less than 0.25%. And so since March 15, 2020, we've been at less than 0.25%. If you guys remember, if we go back to, let me show you. Let me just go back here. This is, let's go to 2007 and 2008. So right here, look at this. We were at 4.25%. Okay, 4.25%, and then we dropped, going into 2008, right? Lower and lower and lower, and then right here, less than 0.25%, December 16, 2008. Now check this out. December 16, 2008, all of these are less than 0.25%. That's 2009, 10, 11, 12, 2013, 14, 2015, and then 2016, we had our first rate increase, right? And then we went up from there. There's 2016, 0.75, and then 1.0, less than 1.0, 1.25. This is 2017, 2018. This is January 31st, 2018. March 2018, 1.75, and then all the way back to 2.5, I think was the highest we went. 2.5 right there, 2019. And then from 2.5, we started to step off back to about 2, and then 1.75, and then 1.25, and then boom, right there, less than 0.25%. And we've been at that ever since. So pretty dicey stuff. We've had a rough, couple of years here. But we can see we kept it the same. And so if we looked at that from the, standpoint of strengthening or weakening, well, it did not increase. It remained stagnant. And if it's stagnant, then that's weak, right? It's not strong. But nonetheless, initially we saw a drop. So if we go back to that date, which would be Wednesday, right? And Wednesday was the 22nd. So we go back to 22nd, which is about right there. So let's go to right here, right? That's where the announcement occurred. So what happened was from here, check this out, guys. You guys got to see this because it happened really quick. So, and this is just the Euro USD. There's all the other USD paired currencies. You'll see something very similar as it pertains to US dollar. So US dollar initially, watch this. So if this goes down, that strengthens US dollar versus euro. So I'm going to replay this. Actually, I'm going to replay the candle before it. Just give that a second to load up. So let's fast forward past this candle. 4, 3, 2, 1, 9 minutes. Let's slow that down. 8, 7, 6, 5, 4, 3, 2, 1. Okay, 57 seconds. Watch this. 10, 4, 3, 2, 24 seconds. So let's just play this at regular speed. It's 24 seconds before the top of the hour. So watch this. So 14, 13 seconds. And for those of you guys, so right there, you can see it automatically, right? The announcement came out, and we saw an initial move, and then another move right there. So it dropped probably, let's go back on a 5-minute. Right here, initially, the first 5 minutes, the first second you saw that, 22.1 pips, and then rebounded, right? And then came back down again. So it had like this 3-wave, which is really common with FOMC announcements, right? So it goes, you see a down move, a up move, and then a down move, right? And then after that, so let's fast forward that. And it's common, but it's not common enough. So we saw the down move, the up move, and now it's kind of pulling back down. So it came up, and then watch how it ends. Let's go a little faster. This is 100 times the speed, but so this is one of those instances where you just kind of look at that. It retraced all of that literally within like 10 minutes. 36.8 pips. Excuse me. So it had that 3-wave, right? It doesn't happen every time, but it happens pretty consistently, or pretty often rather. So it went down, and then it went up, and then it went down. So it had that 3-wave. So that's, showing that the U.S. dollar had strengthened initially, right? And sometimes that'll just carry like the last FOMC announcement. It just continued to strengthen the U.S. dollar. And then, of course, after that, we saw a little bit of rebound. Let me go 1,000. But for the most part, we can see that the U.S. dollar strengthened versus the euro. And with a lot of U.S. pairs, we saw that same strengthening. So again, the announcement doesn't always reflect what's actually going to happen. And it was simple for the larger institutions to take advantage of the retail traders like us, because the announcement was that the U.S. dollar was going to weaken, right? Because we were not increasing interest rates, and everyone expected that we were not going to increase interest rates. So all the traders, all the retail traders at that point, they were likely thinking, okay, it's maybe time to take a long trade, right? And instead the market dropped short, and then came back, and then went back down and strengthened U.S. dollar for a couple of hours, and then started to rebound, throughout the following days. And then, right, so we've kind of stayed in that consolidated range for the most part, right? We're kind of in that, consolidated range right here. We can see on a 1-day where we had, that down, and then that up, and then more retracement down. So we've kind of stayed within this range right here, right? So kind of consolidated, didn't really make a decision in one direction or another. Okay, so not what we're going to talk about today, but definitely really interesting, and this is primarily why we don't trade announcements, right? Because we see that those things happen, right? It's called selling the rumor. So, if you guys have looked that up, it's not a conspiracy. It's just the way the markets work. It's a zero-sum game. So if the banks see that, if the larger institutions see that, a lot of traders are speculating that the U.S. dollar is going to weaken, and they're betting against the U.S. dollar, then it's simple for them to make the decision to go the opposite direction, because you've got a whole bunch of lots, buying when they want to sell, or selling when they want to buy, depending on which currency pair, or if you're just trading the USDX, for example, or you're just trading the U.S. dollar. So, traders will go, short U.S. dollar and go long on gold, and the institutions will do the opposite. They'll go long on the dollar and short gold. and because there's enough counterbalance to be able to do that. So just a heads up there, guys, if you needed proof as to why we don't trade announcements and why we don't listen to all those other, clowns online that say that it's a good idea to find volatility in announcements, there's your proof, right? And that happens more often than not. So it's just, you just don't do it. You stay away from them. Okay. So today what we're actually going to talk about is going to be two setups, and they are the 4-way and the whiplash. So when we first started the Proving Ground Mastermind, right, where we wanted to take a more advanced approach to the indicators with our membership, these were some of our very first patterns. And the reason why we identified these as being pivotal is because they really do illustrate that dichotomy between the major and minor. And so that's all we're really going to be looking at is going to be the major and minor. We're not going to be looking at the TNTs, so we're not going to look at the indicators up here. We're not going to look at the pressure indicator. We're just going to look at major and minor, so on the 4-way and on the whiplash. So this is just showing a whiplash for a buy and a 4-way for a buy. And so I'll explain these to you on this chart here in just a second. So what's cool about this is that we see that intention in majors, especially in instances where perhaps the market is cooled. This is when it's most commonly found, is when the market is cooled, and we can see that the majors are kind of an autopilot. A lot of times there's some consolidation or something. The market's just kind of moving slower. Maybe it's going from a higher volume time to a lower volume time, and then we can just start seeing the majors sometimes lazily follow the minors, or they're following really, really closely with the minors, and then the minors gas out and the majors persist and then give the reversal. And so I'll kind of explain these to you. So this first one, what we want to see on the whiplash, so this is going to be the whiplash first over here. What we want to see is that the major and minor have gone from oversold to overbought, and they're kind of overlapping each other, right? They're right on top of each other. And so if we go back, we can see that they started off, oversold, and then they're traveling overbought, and you can see they're overlapped. So they're not next to each other. Green and red, gray and black are all kind of mixed together. And then they work their way all the way to the overbought, and then when they're overbought, they do this intersection type of thing, right, where you've got minors creating a hiccup, right, or even a soft cross, a very soft cross, and then majors persisting through them, right? So this is something that you actually have to go back and look at the progression, right? Okay, where it started here, moved up, and then the intersection. So right there, the whiplash on that first trade, we would take a long trade. We'd be looking for a long trade. And then after that long trade, and so if I erase this right here, we can see that it didn't move much, but we did get a long trade, right? 7.3, it did move 6.2 down, but it moved 7.3 up. So depending on what our take profit is. But again, we can see that it's actually started off as like when we're cooling in the market, right? Where we're starting to kind of go a little sideways there, right? And then after we have that long trade, then we're actually looking for a follow-up of a short trade. So that's why we call it a whiplash, because it kind of goes, one direction and then back the other direction. Kind of like when you whiplash, right? You kind of go, somebody rear ends you and you go back, your head goes backwards, then it goes forward. So, and that's why we called it the whiplash. So it goes up, and then we wait till that candle terminates, and then at the end of that candle, then we go short. So it's a twofold candle. The 4-way is just a one direction, and I'll go over that here in just a moment. So right here, then we'd expect a sell, and we do get some sell right there. But you can see, again, the market is really cooling, right? So not much of a sell there, but we did get some sell and then more follow through there. Okay, so let's look at our next example here, which would be right here. And so again, we can see that it came from the oversold up to the overbought, and they're together, right? They're close together. They're overlapping each other, and then right there you get that intersection, right? Minors are kind of almost soft crossed right there. They were more hiccups, gray down, black up, but they are touching, so it's more of a soft cross. Majors are persisting, and so right here again we have that whiplash scenario where we're looking for a buy trade, a long trade first. right? So there's our long trade. Let me erase that. And we can see that moved up first, right? 6.4, it only went about 1.2 down. And then after that, then we'd be looking for our sell trade. And again, a lot of times it's just because of part of it is that dichotomy between major and minor, but it's also they find themselves overbought, and now they've got to kind of release some of that buy pressure. But in addition to that, it is during a time where the market is cooling, and generally when the market is cooling, you start to see sideways candles. So if we have a green candle, right, if we've got a green candle here, then in order to go sideways in the market, then we need some down movement, right, some movement in the other direction, right, and that's what makes it sideways. So then you get that consolidation. Or sometimes it takes multiple candles to retrace, right? So it's kind of like, maybe a wick and then a small candle right here, then another one right here, so on and so forth. And then maybe, another one, or, this one has a wick or whatever, right? So it kind of stays in some type of consolidated range. And so that's indicative of that time of day, right? It doesn't always happen, but it's nice to have an indication of when it's going to happen. So right here, after that trade, we'd be looking for a short trade, right, in the opposite direction. There we go. So we get that retracement. That will move 6.8 back down in the other direction. So we do get that retracement. So let's look at it one more time right here. And this is and these are recent, right? These are all in like September. I think I just found some in September. Actually, this one was August, but this one's September. And the other thing is they don't happen very often because they are very unique. And when we're looking at that square peg, square hole scenario, then we want to make sure that all of our parameters are present. And because it is very specific, going from oversold to overbought, looking a certain way when it does that, then that decreases the frequency in which it occurs. So right here on our third example, we can see that we're oversold, and then we start to travel up and overbought, and we can see we actually start off with a really strong move there, and then we get overbought. We've got that intersection again, right? Gray down, black up, majors persisting. Again, we're not using any of the other indications. I'm not saying that you shouldn't or can't. I'm just saying that at its base level, we're really not implementing or using any other indication. So right here, then again, we'd expect that long movement first. And right there, this one actually gapped, right? And I'm not entirely sure why, because it wasn't over a weekend and it wasn't end of day yet, but we did see a gap, so our entry would have been somewhere here, right? Because that candle ended there, but then this one started here, and that's where we would enter the trade. So it entered there as it went up. And then we'd be looking for that sell in the opposite direction, the short in the opposite direction. And there it is. So a lot of reason for that is because what we're seeing is that the miners are, and we talked about this in the mastermind actually this last Wednesday, is that as we became overbought, then in order to persist to the long side, in order to persist up, then there has to be some of that pressure that's alleviated that was attributed to buying in the market. Otherwise, you run out of, it's a zero-sum game, right? So you run out of room to go up. So as the miners kind of digressed and either took profit or released trades or whatever it may be, or took opposite positions, then that gave the majors the ability to continue to persist up. So then they persist up, and then after that, generally they'll find themselves in again, very vastly overbought. Plus, you're kind of in a consolidated range, or you're beginning its consolidated range, and so then we get that relief again back to the short side. And so you can see again the candles start to move sideways. And it's nice, again, it's nice to be able to know not when the market is moving sideways, but when it's going to start moving sideways, right? I think a lot of us don't like trading when the market is sideways because you're trying to, get an indication of an overall direction, and for others, we like trading in those consolidated ranges because, you kind of map it out really simply and you kind of see, okay, this is about the range, and then you're looking for those max outs at those levels, right? Majors and minors would be overbought when it's at the top of the range, or major minor would be oversold into the bottom of the range, and then maybe use a 5 minutes of position and take a trade in the opposite direction. So it becomes really simplified, because then you're not looking for anything too fancy or intricate, but you're just identifying that at that moment we are moving in a consolidated range. So it's nice to be able to catch the beginning of that versus waiting for it to now be in a consolidated range and then hoping that it continues in that consolidated range. And again, pressure is great for being able to identify those sideways movements in the market, right? And we can see that pressure was divergent. There's a lot of sideways, so that that really benefited us there. But again, for this particular square peg square hole scenario, we're not really looking for pressure. And again, when you backtest, you can include pressure or TNTs or whatever it may be, but at its base level, at its base pattern, we don't even have pressure as a or any other indication as a parameter. Okay, so let's look at the four-way. Now, the four-way is a lot more nuanced, and what we see with the four-way is that the major and minor, and this is one of those scenarios where we start to get into that consolidation by way of major minor, and sometimes within that we can see that the minors, so notice the minors are pointed down right now and the majors are pointed up. Now, of course, they're kind of gassed out, and so they're likely to give back, but watch how they just kind of lazily follow the minors down the channel, right? So minors are leading, right? Majors are following. Minors leading, majors following, and then right there, minors gas out and majors persist. Okay, so right here, a lot of times what we find is when they've kind of followed each other down and they're not overlapping, right? That this is a softer indication of continuation down, right? And you can see that it is very similar to what we were seeing in the in the whiplash, right? Except that one nuance where minors kind of led, majors followed, and they're separate. They're not overlapped. They're not laying on top of each other. And then they do that same type of intersection right here, right, or overbought. I don't think we have any that are overbought. But right there, then what happens is that when we get oversold, then we're starting to look for a long move, right? Something more significant to the long side. We know that sometimes it'll still go short a little bit, just like anything else, just like, we did see a little bit of draw on some of the whiplashes as well. But for the most part, we want to see that it's going to start kicking long or up. And part of that is because the majors just kind of let the minors get away with that for a little while, right? Get away with kind of moving the market and just kind of going with the flow as things started to progress from overbought to oversold, because sometimes it'll create that room, and other times it's because that's going to be the overall direction, and so they start pushing more aggressively in that direction for retracement's sake or for reversal's sake. And so right here versus going down, selling, and then buying on the next candle, we're just going to go ahead and buy or go long. And this is one that is best used with some type of positioning, like a 5-minute chart. And maybe next time we'll talk about aggressive positioning. But it can be used with positioning because it is more subject to drawdown than usual. So when you're back testing, just keep an eye on how long it takes to draw down and come back to break even, and how many pips you usually draw down, because you'll find something in there that's kind of that sweet spot that 80-90% of these trades will draw down for 2, 3, 5 pips depending on the time that you trade, and for a certain amount of time. And then it's like, okay, I'm just going to wait for that, right? I'm going to wait for that drawdown first, and then I'm going to enter that trade. And that's going to actually help increase your drawdown, your risk-to-reward ratio. It's going to help, you get out of trades faster because you're positioning more aggressively. But in this particular instance, we're not going to talk about aggressive positioning. We're just going to look at it at its base form and value. So we'd be looking for a long or a buy trade. And right here we can see some of that, right, where we get that down first 5.9, and then it goes up 4.3. So it actually went down more than it went up. But again, depending on your stop loss and take profit, you could still be active in that trade, right? and then we start to see it kind of kick on as we get to the next candle, and we start to see long movement, 9.4. And there's a lot of times where we'll see it immediately, even with drawdown, right? Maybe some drawdown and then a bigger, green candle and so on. But the most effective way to trade this four-way is going to be with some type of 5-minute positioning, right? Otherwise, if you're anything like me and you don't like to sit in trades for very long, then you're going to find yourself frustrated with this type of setup. If you don't mind that, then it's not going to be a big deal for you. All right, let's look at another example here. And so again, we can see that same nuance where minors kind of take the lead, right? And majors are still kind of hanging back. This is almost like a head fake, right? Except for that we're starting to get convergence there. In any event, it's not a head fake, but close, and green's on top still. Actually, that's where green would need to be in pressure, but it's not a head fake. So watch how they kind of go, majors follow the minors from overbought to oversold, right? See the separation. They're not overlapping each other, so we still have separation right here between majors and minors, where with whiplash, they were overlapping, right? We can see that in the whiplash, they were overlapping, where with the four-way, they're not overlapping. They're separate as they move their way down the channel. And right there, we get the intersection, right? Again, we've got gray up, black down. Majors go through. So right here, again, we'd be looking for that pop to the long side, to the buy side, right? So let's click forward. And we do get both directions. So again, 5-minute positioning, right? It only went about 3.4, and then it went 4.8 up. So again, not a lot of movement. And back to the point that we were initially making, it's generally a time where the market is cooling, right? We get, you can see we got a definitive direction, and then we start to go kind of sideways, right? A little more kick up there, 9.1, and then some more there, 15.9. Okay. So again, we see that dichotomy, right, where sometimes, and that's what allows for us to be kind of those fair weather fans, where sometimes we trade with the majors, most of the time we trade with the majors, and other times we may choose to trade with the minors. So throughout this, downward process here, overbought to oversold, the decision could very well have been to begin to change from a bullish approach to a bearish approach and start to short, right? Start to sell. And we can see it kind of kicked off with, dirty pressure. We see that we've got dirty pressure there for those of you guys that have attended our session on dirty pressure. So we did get some indication that we were going to start to see some selling, and that persisted up until about there, and then a little bit of the next candle. But even from that point, I mean, that was like 8.5. So again, not a lot of movement there, and then we started to kick back up to the long side, and then some stronger moves there back up. Okay, so let's look at our last example here, and this is another four-way. So again, starting from overbought, we can see that we're vastly overbought, and then they follow next to each other in a hurry, down from overbought to oversold, and right there, right there, we get that intersection, right? And it's this is almost like a soft cross right there by way of minors, and then majors are persisting through after having followed the minors from overbought to oversold, and then we start to get that pullback in the other direction. Not too significant, 3.7, went about 2.4 down. So again, we're seeing more of that cooling. Doesn't look like we created a new high. 4, so a little bit. And let's see. Generally, when this stuff happens, then we may go up for a couple hours and then get some strong movement back in the overall direction. It's 5.1, 9.8, and then see there's that stronger movement back in the other direction. So what we're seeing there is kind of, is like retracement, right? So if we go from here, if we looked at just the retracement that we're experiencing at that point, we could basically take this, our high, let's just say right there, to our low. See, where's our low? Right there. What am I on? TC1? Erase that. Do that again. There we go. So we see that, look at that. It tagged the 50%. So the ones that I have marked off are 23.6 to 50% retracement. And I don't use this to trade, guys. I don't use Fibonacci. Man, you guys could go back, for those of you guys that are mastermind members, you guys can go back on some of the videos of Fibonacci and you guys can see how, like my walk the dog method and things like that. And, but a lot of that was because early on, I mean, we had traders who just would not let some of that stuff go, like Fibonacci, support resistance, trend channeling, all that stuff. So I got really good at that stuff initially too, because when I first started that, that was like, we were still teaching that type of stuff. And then as things progressed, realized, there's really not a need for it. If anything, it stops you. It makes you second guess some of your trades, because our indicators are a lot of times telling us things that are counterintuitive to some of these things, and that's by design, right? That's what gives us that competitive edge, because where other traders might be buying, we're selling, or where other traders might be selling, we're buying, and we're winning at a more at a higher win percentage with risk to reward ratios that are more profitable. So it makes sense for us to do something, to do what we're doing versus what everyone else is doing. But in instances like this, it is noteworthy to kind of check that, and you will see that there are some nuances. But the thing is that it's only good at hindsight, right? We only know that 50% stopped it at hindsight because we know what the next candle was. It was a red candle, and then boom, it hit right at that 100% or zero level, right? So we can, and possibly even made a new low. So we could see that after the fact and say, okay, yeah, that was pretty textbook. But that's something that happens, and I'm not talking about that specific retracement level, but that's something that happens really often, right? Because that's indicative of a trend, right? Where we have, move down and then a retracement back up, and then a move down and then a retracement back up, so on and so forth, right? But in and of itself, it's not enough, right? Because, sometimes it's like, okay, when does the trend end? Like, for example, right there happened to be the end of a particular trend. Right? If we kind of looked at that from this perspective, let me just go to a clean chart. Overall, we can see, yes, we were in, a bit of an uptrend right here, right? And just for giggles, I'll just, if I was going to draw, that would be more like that. We kind of broke out of that and started going short, and then saw another low right there, right? So we kind of started seeing this occur right here. Right? So we can see everything is kind of, so let me paint a clearer picture for you. Let me go back here. Okay. So those are fib levels on a trend. So we can see that, we came back up. We actually got through the 50%, went to the 61.8, and then came all the way back down, and then hung out there, went above 23.6 and 38.2 level, then went sideways. And then right there, we started to then see, some down movement that broke us out of that channel and into more of a downward channel, right? And right there gave us further confirmation. So if I had to venture a guess, I would say that 50% is probably going to be somewhere, you know, right here at the tops of those levels, right? That's going to be like the 50% line. So let's draw it real quick. Let's see. Yeah, so right about there, right? Came up back up to that 50%, and then started to pull back down to the bottom of the range. And then then we started to bounce off the bottom back to the top of the range and held it. See that? Back to the bottom, held it, back to the top, held it, and then broke out of it. So now we're kind of somewhere in the in-between, right? In the upside down, right here somewhere in this triangle, right? So, I mean, was any of that useful based on where we were in that sequence? Well, no, because at that point, we've already popped out of the buy trend, and now we're selling, and then it starts to buy, and then sell, and then start to buy again, and then sell, and then buy again, right? So it's like, okay, where do we jump in as a result of that, right? The trend is your friend until the end or until it bends and all that other garbage. But really, it's never your friend. It's not a very reliable friend, and it only tells you what's already happening. It's not telling you what's going to happen. It's definitely more advantageous when you have something that tells you it's going to happen versus what's already happening, right? And then as we continue to progress, we don't even get back into that old trend. I mean, I guess we could likely, you know, just build a new one, but it wouldn't have anything to do with this upward movement anymore, right? I mean, we could try to justify it, but watch what happens. The only reason I'm showing this trend stuff is because I want you guys to see that it's, you know, it's not very useful. Adjust drawing. Whoops. So right there, maybe even right there, because that'll take us back to here, right? Was he dropped in, went down to 61.8, popped back up, went all the way down, and then came all the way up, and then consolidated, and then went back up, tested that top again, all the way back down, up, a little bit of down, and then up to the top of the range, and then after that, we started to see more down movement, right? And then that came to an end, and then we started to see more aggressive up movement, right? So you can see it was kind of a roller coaster, and if you're trading that, you'd be all over the place, and that's, you know, if you're confident in your trend lines and all that other stuff. And really, I mean, versus doing all that, Matt, I mean, if we go far enough, you can see that, I mean, once we pop out, at some point we kind of jump back in, right? But now it's not even relevant anymore. Now it's kind of, we would erase all of this, right? And we would actually look at it, because this is more consolidation. This is all sideways right here, right? Kind of stayed in a range. No higher highs, no lower lows from this point right here. So that creates a high, that creates a low, and we stay in that range until right there, right? And we're in there from about right there. So erase that. You can see so we get in on that candle into this range, and then we kind of stay in that range, right? We finally make our high, right? Which is not higher than our higher high over here, but that was more attributed to this down push right here. And then that down push ended right there, and then started this up push. And then this up push ended with this sideways push. It just kind of went sideways right there in that range. And then that ended with this up push. More sideways, and then some spikes up. Right? So long term, we can see that it started to go up, but we're not even starting. We wouldn't even start our trend until right here, because now we have up, down, up, down. Right? So somewhere in here, Actually, that would be the down. So down. Somewhere in here, we'd have to identify our uptrend and if it continued, right? Down, up, so on and so forth. And again, that's only useful after the fact, because if we try to use that same methodology back here, when we thought we should be selling, it started to buy, and when we thought we should be buying, it started to go sideways. So you're just chasing your tail. You're just hoping that whatever's happening is going to continue to happen. Okay. Throw that indicators back on. And if you guys are part of the mastermind, you can go and look at some of the videos that we talked about with regard to support, resistance, trend channeling. What ends up happening is if you've got a resistance level, right, or let's just look at an exaggerated example, right? So clean chart. So right here we've got a support level. Let's just find it. We can use that. Okay. So we got that support level. So then we become afraid to trade beyond that support level, right? Because now there's this thing right here that says that the market is likely to bounce off of it. Likely, but obviously every support and resistance level that there is will get broken at some point. And by the way, everything, if you go back far enough, is a support or resistance level. I mean, I'll just draw somewhere in this area where there's not even candles right there, right? And I think we've done this before, but I just want to show you guys because I know that there are some of you guys that want to use this kind of stuff, and it's hard for you to get away from this stuff. But this stuff is what's keeping you trapped, And again, when we bring people into our organization, again, if you're an existing trader, that's one of the things that we ask of you is if there are things that we need you to forget and let us retrain you on, you got to be willing to do that. Otherwise, it just doesn't work. And this is some of those things that are hard to pull away from people because they just see these things, right? These support resistance levels just pop out to them. And it's because of those support resistance levels that sometimes they're not making money in the market. But I mean, I'll just draw two random lines somewhere, right there, right? And if I go back far enough, let's just go back here, we'll find that at some point, those were support and resistance levels, right? Look at that. That one was like right there, right at the top as these candles came up, boom, hit it, and then stayed below it for at least a little bit of time, right? We'd probably even find something better than that. And then let's go back further and check that other one. Right there. Boom. And it just drew those at random, right? And that's the thing is that if you're drawing support and resistance, yeah, you could draw right there. That obviously bounced off. And right there, that obviously bounced off, right? Right there somewhere, we can see there. And right there. And that all looks well and good, right? We can see that, market came, bounced, hit that again, and then broke through. And then went up, checked that level again, broke through. Went up, hit that level, came down, hit that level, up, hit that level. Again, another test there. Down, hit that level again, and then broke through. And then broke through the other level, hit flat there, right? It looks great, right? It was tested there and there. That all looks great, but if we go back enough, we'll see that those levels even got broke at some point, right? Right there, it seems less relevant, and that's like a day before, right? I mean, yes, a little bit right there. This didn't look very useful there, right? That worked there, right? But you can see how it's not consistent. We're not going to count that just because that was the announcement, right? But you can see there's just no consistency in it. And what ends up happening is you start thinking, well, I just need to draw better support and resistance lines, or I need to draw better channeling and trend and all these different things. And eventually your charts look like a big old mess, right? You've got all kinds of stuff on here that, you think that you need in order to be successful at day trading. And you don't need half of that stuff, right? Might have some trend lines in here and fib on your fib, and and this is what you're staring at when you're trying to trade. You're like, if I could just get, from here to just a little piece right there, on the next candle, and it's like all that, analysis, all that time, effort, and energy to have a 55% win rate is just a waste. And that's not my opinion. That's just a fact. That's just a waste of time. So don't waste your time with that. For those of you guys that are still using that kind of stuff, there's definitely a better way, and we're showing it to you right now, right? This is one really good way. And again, it's not relevant if we're getting a whole bunch of movement or not, right? It's all based on our risk. So, and we've talked about this numerous times, right? It doesn't matter if I'm going for, 10 pips or 100 pips, right? If my risk is 1%, and these are equal, right? So let's just say it's a 1-to-1. So I've got a 10 pip stop loss and 10 pip take profit, and a 100 pip stop loss and a 100 pip take profit. So I have a $2,000 account, say for example, right? So $2,000 account. Well, what's 1% of 2,000? It's $20. So if I were going to go 100 pips negative, right, and it equaled $20, then that would be like a point. It'd be 0.01. Let's see, no. $1, nope, 20 cents a pip, so 0.02 times, which is 20 cents a pip, times 100 is going to be $20. And then on this one, 10 pips that equal $20, that's a 0.2. Which is $2 per pip. So that's 20 cents. This is $2 times 10, right? Our stop loss equals $20. So if I win this trade, it's a 1-to-1, so I make $20. And if I lose it, I lose $20. If I win this trade, I win $20. And if I lose $20. So I made the exact same amount in 10 pips as I would in 100 pips. So again, the amount of movement doesn't matter. I mean, if it matters to you because you want to show off, great. But believe me, you can't pay your bills any better than you can with 10 pips. Except for that, 10 pips are obviously going to happen more often than 100 pips, right? So if we're looking at it in terms of overall growth and compounding, you're going to be more profitable with a short-term scalp approach than you will a long-term. It will just outperform it every time. Right, because of that compounding effect. If you're trading 1% of your account, then and you take, 10 pips, and you win that trade, now your account is 10% or 1% larger than it was. Therefore, your new percentage will eventually start to increase. Right, your new lot size will increase. Right, it's not going to stay based on 2,000. It's going to be $2,020, and then 2,000. And $42 and so on and so forth, right? Where that larger trade that you're not able to take every day because they're not going to show up for you that often, are equal to the same amount as each individual smaller scalp trade, but one, you're not taking them as often, and two, you're not getting that compounding effect. So it may take 10 trades to make 100 pips with your scalp approach, but by the time you get to the 100 pips, you would have made more than with one trade at 100 pips altogether, right? Because each trade will compound on itself. So when you get to the end of those 10 trades, you're going to have more money than you would than just taking one of those trades. So if that wasn't clear, you guys need clarification on that, there are videos on that as well. Okay. If you guys aren't, my assumption is you guys are subscribed. If you're here, you guys are subscribed to us on YouTube. If you're not, go in and subscribe on YouTube and check out some of those videos that we've got on our YouTube channel, youtube.com/The Proving Ground. Okay. So as always, I want to throw out the offer that we always throw out, and that is for our Trader Lite program. We're still on this $10 promotion. So that $10 will be donated 100% to our charity partner, Feeding America. You're going to get access to the indicators that you were just looking at. You're going to get the access to the alerts and tutorials. So the indicators are where the alerts are based, obviously. And for those of you guys that have been, coming often, then you guys understand that. You guys know that the alerts that we send out are based on the indicators that we offer through our program. You're going to get access to live trading webinars, not just this one, obviously, but others that we do for members only, where we take trades with our members and things like that. Live coaching webinars, on-demand trading video library, Trader Chat. We actually just rolled out our new Trader Chat, which is awesome. Our members are loving it, so definitely come and check that out. Even if it's just for that, you're going to see that it's more of like a community than it is just a chat, right? Chat group, right? We're just creating this community out of it. It's pretty awesome. And then we are throwing into 2 one-on-one coaching sessions with a professional day trader, and those are going to be beginner sessions, so you're not going to feel overwhelmed. We're not going to, try to, have you drink from a fire hose. We're just going to show you some really simple things, make sure that, we're a good fit for you, you're a good fit for us, we're all on the same page, and then we can talk about our next programs, which are our coaching programs. We actually just rolled out 2 more coaching programs that are awesome, and so when you get involved in the Trader Lite program, we can talk about those. Those 2 new ones are just to address some of the economic downfall that we've seen as a result of COVID-19 and the pandemic, and so they're a lot more affordable. So definitely, when you guys are get involved and sign up for the Trader Lite, ask about those programs and we'll explain them. For the most part, they've just moved out of beta. We've tried a rendition of them in the past, and we figured out a really nice winning formula for those other programs, and so that's kind of how we built it. And again, we'll talk about those as you progress through the Trader Lite process. So go to daytradesmart.com/free and sign up for that for $10 and schedule your one-on-one session, and we'll go from there. Until next week, guys, I appreciate you guys joining us, and we will pick back up again on Tuesday. If you guys are involved in the mastermind, we'll see you then. Otherwise, we'll see you next Friday for the sweep. Have a good one and happy trading.